Welcome to the Deep Dive. Our mission, simple. Cut through the noise of these big corporate calls, give you the insights that matter. Today we're digging into Havells India, specifically their Q2 FY26 earnings. A consumer electricals giant, as you know. We've gone through everything, the financials, what management said, the segment details, and, well, it's a bit of a puzzle. How does a company pull off an almost 19% jump in profit when revenue growth is just scraping past 5%? That's what we're tackling. We'll show you where the real strength is, the structural parts, and exactly how that seasonal drag pulled down the margins this quarter.
Yeah, and that context is crucial. Remember, this call happened after market hours, October 17th. The stock was already feeling some pressure, lagging the indices. So management had this delicate balance to strike. They had to talk up the solid long-term B2B stuff while being upfront about the, intense short-term pain in consumer goods. The market wanted clarity, not just spin.
Okay, let's lay out those core numbers then. Consolidated revenue first. It grew, but modestly, up 5.3% year over year, came in at 4,779.3 crore, that top line.
Yeah, it definitely gave people pause.
Right, but here's the split, the real story. Consolidated profit, after tax, it didn't just nudge up, it surged. 18.9% year over year. That's 319.1 crore. Translates to a basic EPS of 5.09.
And the operating profit?
Just as strong. Standalone EBITDA, that's often used as a proxy, grew a healthy 16.3%, hit 442 crore. So operationally, pretty robust.
Okay, that is a striking difference. Solid profits, despite that environment they talked about. So why was the market reaction basically flat, a 0.0% move right after? You'd think, a profit jump like that would generate some buzz.
Well, it really shows you how savvy the market can be looking ahead. Despite the great PATE-MET number, investors had, I think, already priced in those seasonal headwinds everyone knew about. They sort of expected the stronger structural bits, the B2B side, to carry the weight.
Oh, okay. So the results didn't really surprise them. It was more like confirmation. Exactly. It looked like a profit beat, but functionally it was more of a meet because the underlying driver, that B2B strength, was anticipated. People were essentially waiting to hear about the consumer recovery, not just cheerleading the cable segment again.
Right. Let's unpack that heavy lifting then. Structural strength versus seasonal weakness. Where did the growth actually come from?
Okay, number one, the core engine. Cables.
Yeah.
Absolutely carried the quarter. Revenue there was up a very strong 12.4% year over year. That's 2,028 crore. Management was clear. Good growth in power cables. And importantly, margins got better compared to a weaker base last year.
And they have a target there.
Yeah, they're aiming for a 15% to 60% contribution margin in cables. That segment, it's really the foundation.
And it sounds like they're investing to keep it that way. Future-proofing, you mentioned.
They are, big time. Cable capacity expansion is moving ahead. Prime example. They just bought a 39-acre plot of land right next to their existing Alwar facility. That's not just a small move. It signals huge confidence in, India's infrastructure spending, government capex, all the things that fuel demand for power cables.
Okay, makes sense. What about the other stable parts, switchgears and lighting?
Also solid. Switchgears grew 8%, hitting 596 crore. Lighting was up 7.4% to 420 crore.
And in lighting, I noted the comment about LED prices stabilizing and maybe some early signs of residential demand picking up. That feels significant, maybe.
It does. It could be an early indicator for broader consumer sentiment. You're right. And for switchgears, margins are just, boringly reliable, holding steady between 37% and 40%.
Okay.
These are the dependable workhorses, generating the cash to smooth things over when the consumer side gets bumpy.
Which brings us to the bumpy part, the seasonal drag. This is where the story gets tough.
Yeah, absolutely. Let's start with ECD, electrical consumer durables. Revenue there actually dipped slightly, down 1.8% to 842 crore.
Why was that?
Primarily fans, they saw mid-single-digit degrowth. And coolers. Significant degrowth, both victims of that shorter, weaker summer season. Plus, there was this hangover, too much inventory already sitting in the distribution channels from the previous season.
Right. But the real pain, the division that got squeezed the most on margins, was Lloyd, their consumer appliances arm, down a massive 18.5%. Only 479 crore. Why so much worse than ECD?
It really comes down to the product mix and the sheer volume of that inventory problem. Lloyd is mainly AC's air conditioners. High-ticket items, very seasonal. Management specifically said the channel inventory for ACs was even worse than for fans, just too many units stuck out there.
Okay, and that forced them into some painful decisions that crushed margins.
Exactly. Two big things. First, they had to drastically scale back production because, well, why make more ACs when the warehouses and shops are full?
Right, and that leads to this under-absorption issue you mentioned. Explain that a bit more. It sounds technical, but it seems really key here.
It's absolutely key. So imagine you've got this huge factory built to make, say, 10,000 ACs a month. You have fixed costs, rent, insurance, salaries for supervisors, the machinery depreciation. All that stuff costs the same whether you make 10,000 units or 6,000 units. But if channel inventory forces you to cut production down to, say, 6,000 units, you're now spreading those same fixed overhead costs over fewer units.
So the cost per AC unit produced shoots up.
Precisely. Each AC suddenly becomes much more expensive to make, just from an accounting perspective. That directly hammers your gross margin.
And then to move the existing inventory stuck in the channel, they had to get aggressive with discounts.
Yep. They had to use direct consumer schemes, special offers.
Yeah.
Basically, cutting prices to clear out that backlog. Management even confirmed these schemes were recorded above the contribution margin, meaning the cost of those discounts hit their profitability hard, right in the cost of sales line.
Wow. Okay. So high inventory leads to lower production, which leads to higher cost per unit due to under-absorption, which then forces aggressive discounting. A nasty cycle.
A textbook nasty cycle. It perfectly explains that huge 18.5% revenue drop and the margin pressure in Lloyd. It shows what happens when demand evaporates faster than you can adjust your fixed costs.
Got it. And just to be clear, before we look forward, there was that one-off gain, wasn't there? About 45.3 crore.
That's right. Good point. Came from selling their old Faridabad asset after relocating production to Siabad.
So it helped the final Titan number look better, but it wasn't really part of the core operational picture we just discussed.
Exactly. A nice cushion on the bottom line, but the underlying story was definitely about battling that inventory.
Okay, so looking ahead, what's the path back? Management must have given some guidance on recovery.
They did. They were quite specific, actually. They expect this channel inventory mess to normalize, basically clear out by the end of Q3. But crucially, the positive impact on margins, getting that operating leverage back as production ramps up again, that's expected to really show up in the Q4 results.
Q3 normalization, Q4 margin benefit, that feels fairly quick. What are they banking on to make that happen, besides just time passing?
They pointed to a few catalysts. First, the upcoming festive season. That should naturally provide a lift to retail sales, helping clear some backlog.
Okay, makes sense.
Second, they're hoping for better sentiment after the GST rationalization. That's expected to help categories like ACs, potentially making them a bit cheaper for consumers. Also impacts PV and solar, which ties into another area.
Right. And the third factor, you mentioned pricing earlier.
Yes, and this is maybe the most important for margin repair. New BE Norms Bureau of Energy Efficiency standards are coming in January for fans and ACs. This means manufacturers have new compliance costs. Havells fully expects to pass these costs on through price increases.
So regulation actually helps them raise prices back up.
Effectively, yes.
Yeah.
It gives them cover to push prices back towards, maybe not fully, but closer to where they were before recent GST cuts. That structural price lift is key for restoring margins in ECD and Lloyd.
Interesting. Okay, shifting gears slightly to strategy and investment. That Goldi Solar investment, 600 crore. What's the thinking there?
It reinforces their move into renewables, but in a measured way. It's an adjacency, accounted for via the equity method, so it doesn't consolidate directly right now. Management noted Q2 is seasonally weak for solar, but they expect, and I quote, very decent growth in the second half of this fiscal year. So looking for a contribution later on.
And this ties into broader capital spending plans.
It does. Total CapEx for this fiscal year, FY26, is pegged around 1,450 crore. That's significant. And they're already estimating another 600 crore for FY27. It signals a major reinvestment phase. They did give a heads up, though. Expect lower interest income in the second half of the year because they'll be spending down their cash reserves to fund all this CapEx.
Makes sense. We also heard comments about cost discipline, right? Focusing on productivity. How does that fit?
Yeah, that ties right back to the margin recovery story. They basically said their big investments in sales infrastructure, R&D, digital, those are largely done. They're maturing. So the focus now shifts, not building more, but getting more out of what they have specifically, enhancing workforce productivity.
Which implies tighter control on hiring and salary growth.
That's the strong implication. Employee cost growth should be managed much more tightly. It's another lever they can pull to help achieve that operating leverage and margin expansion.
So it all connects back to that long-term picture. B2B, driven by infra spending, remains strong. Long-term, it's about the brand, premium products, distribution.
Exactly. And management sounded confident that this focus plus the productivity gains should lead to, well, a pretty significant 150 to 200 basis points of margin expansion for the standalone business over the medium to long term.
150 to 200 basis points.
Well,
That's the potential upside the market is weighing against the current pain.
that's the core investment thesis, yes. Can they deliver on that expansion?
Which brings us neatly to our favorite segment. This is not financial advice, where we spin out a, let's say, bold trade idea based on everything we just heard.
All right, so consider this. The stock's taken a bit of a beating recently, down about 6.5% in the last month, roughly. And the market basically shrugged off these results, strong PAT, but weak revenue. Our argument is that short-term pain, the seasonal drag, it's fully baked into the price now. It's known news.
Okay, so the setup is the negativity is priced in. What's the play?
The pitch is basically an execution bet. You go long Havells, specifically betting on that H2 recovery they guided towards. You're timing it around their forecast, believing that Lloyd's inventory does normalize by Q3 end, which then unlocks that operating leverage and margin repair we should start seeing in Q4.
So betting on management's execution over bad weather, essentially.
Pretty much. Betting the strong B2B foundation gives them the resilience to pull it off.
How do we make it outrageous, though, and maybe hedge it a bit?
Okay, for the structure, make it a paired trade. To hedge will the consumer actually bounce back? Risk, you could say, short volatility on a purely weather-dependent product index. Or maybe cleaner, short a competitor, a high beta consumer durables company that doesn't have Havells diversification, doesn't have that strong B2B backbone to lean on.
Right. And the outrageous conviction part.
The conviction is that the brutal 18.5% drop in Lloyd, that was the absolute bottom, that the margin pressure isn't just going to ease, it's going to reverse, and sharply, right after the festive season, clears the decks. So sharp, in fact, that it puts them firmly back on track within, say, the next year, to start delivering on that 150, 200 basis point medium-term margin expansion goal they keep talking about.
A bet on a V-shaped recovery in B2C, fueled by execution and pricing power.
Exactly. High conviction, high risk, based purely on timing that inflection point correctly.
Okay, that's definitely a thought provoker. So let's quickly recap the whole call for you listening. Q2. It was really a tale of two companies within one. You had robust structural performance cables, Switchgears holding strong, but that strength was masking or maybe subsidizing a really tough time in the seasonal consumer businesses, especially ECD and particularly Lloyd, due to that inventory overhang.
Yeah, and the things to watch now are crystal clear. First, that Lloyd inventory normalization. Does it really clear out by the end of Q3 as guided? Keep it on channel checks there. And second, look for hard evidence that the festive season is actually boosting B2C demand enough to support that Q4 margin rebound story management is painting.
Excellent summary. And one final provocative thought for you to take away from this deep dive. Management, they didn't just hint, they explicitly reaffirmed that goal, 150 to 200 basis points of margin expansion in the medium term. Now, given the current stock price seems weighed down by the Q2 inventory issues, the question is, does the market valuation today adequately reflect that very specific, potentially quite significant future operating leverage they're aiming for? Or is there an opportunity there? Something to think about. As always, remember, this is purely informational based on the earnings call materials. It is definitely not financial advice. Always seek professional guidance before making any investment decisions. Thanks for joining us for this deep dive.